within 1 lakh at the rate of 10% on the income exceeding 1 lakh portion. So in that case, tax will be calculated at 10% and surcharge will be limited to 15%, and accordingly we will be calculating the tax rate. So we'll move on to tax rate for the domestic company which were brought into by the Finance Act. So while looking for a domestic company, we will be looking at the turnover for the year financial year 17-18. So the reason we look for the financial year 17-18 is that when the budget is brought into at that point of time, the turnover for the financial year 18-19 is not yet finalized. So the CBDT always comes out with that provision because so CBDT always brings out the turnover limit of the second preceding financial year, so that there can not be any litigation with respect to turnover. So in case if the turnover of the company during FY 17-18 is not exceeding 400 crore, so basic tax rate at 25% will be applicable, and the applicability of surcharge will be depending upon the taxable income. So in case if taxable income is between 1 crore to 10 crores, so in that case surcharge will be applicable at the rate of 7%. And in case if the taxable income is more than 10 crore rupees, that is if the company is earning more profit, in that case surcharge will be applicable at a higher percentage of 12. However, cess will be applicable at the rate of 4% in all of the scenarios. In case if the turnover of the company during financial year 17-18 is exceeding 400 crores, so in that case, my basic tax rate will be increased to 30% from 25%.
Uh, there you are on mute. Just unmute. Yeah.
Okay, wait. Is that now audible?
Yes.
Am I audible? Okay. Uh, in also in September 2019, in order to achieve the 5 trillion economy target and also to boost the sluggish economy, an ordinance was passed. And if we compare to standard tax rate in different developing countries, it was observed that the tax rate in India was much higher than the other developing countries. So in order to boost the economy, two reliefs or optional sections were provided, introduced, which were section 115 BAA and section 115 BAB, in which option to pay tax at lower percentages was given to the company. Under section 115 BAA, option to pay tax was provided at 22%, and in case of section 115 BAB, option was given for the company which were engaged in manufacturing business, uh, at the rate of 15%. However, the option was subjected to fulfillment of certain condition, which we'll be discussing in the coming slides. Since lower tax rate benefit was provided to companies, certain deductions or certain benefits were not given. So certain specific deductions were not permissible, which include section 10AA deduction. That is, if the units are located in SEZ, then the whole income is exempt. Then other specific deductions such as 32AD deduction, which is provided for investment in additional plant and machinery. Then 35AD deduction, which is provided for setting up units in notified areas. Also, many profit link incentives of Chapter 6A were also restricted. However, out of the Chapter 6A deduction, Section 80JJAA was available, since the same section aims to generate employment opportunities. Also, a point to note over here is that the loss attributable to specific deduction was also not able to be set off in case if the company is opting to pay tax under new regime. However, other normal provisions for normal other losses would apply, and in case if there is loss due to unabsorbed depreciation, unabsorbed depreciation in the previous year, then in that case, CBDT had said that it will be coming out with notification in order how to set off such losses. However, the same has not yet been amended. Also, CBDT had said that while introducing this section, depreciation rates will be brought out. However, the same are not yet amended or not yet notified. In case if the company is opting to pay tax under this regime, additional depreciation which is allowed under section 32(2) won't be allowed for the assessee in case he chooses the option under this section.
One
So
point here over the area. We should understand why are these alternative taxation, the regimes which are being introduced by the government. What is the actual motive? So the government has realized that there are hundreds of sections which provide for deductions and exemptions in the Income Tax Act. So what they want to actually do is they want to phase out all those deductions and exemptions, and as of now, they have made these regimes as an option given to those companies. But in the subsequent years, the regular exemptions and deductions would be deleted or phased out, and these sections will be made mandatory in the subsequent assessment years. That's the overall motive why they've introduced these sections. Over to you, Dhairya.
okay. So how to basically compute income in case if the company is opting to pay tax under this regime. So special rate for short-term and long-term equity gains will be applicable under section 111A at the rate of 15%. And in case of long-term capital gains, tax rate will be 10%. However, on the balance income, uh, new tax rate will be applicable. In Also, in case if the company is opting to pay tax under new regime, surcharge will be applicable at the flat rate of 10%, irrespective if the income consists of short-term or long-term capital gain. So, in a point of distinction over here is that in case of individual, higher surcharge rates were not applicable for short-term and long-term. However, in case of company, surcharge will be applicable at the rate of flat 10%, irrespective of short-term or long-term capital gains income. So, since as discussed earlier, the scheme is provided as an option to the company. It is not necessary that company should opt the particular scheme in the given year only. The same scheme can be opted in the coming years also. In case if company is opting to pay tax under the new regime, then Form 10 IC for Section 115 BAA and Form 10 ID for opting under Section 115 BAB are being notified, in which the company gives a self declaration to the respective assessing officer stating that the company will be opting to pay tax under lower regimes. However, the same form has to be filed on or before the due date of furnishing of return of income in the year in which the company is opting to pay tax under the new regime. So suppose for financial year 1920, if the company is opting to pay tax under the new regime, then in that case, the option has to be filed by the company on or before the due date of filing of return for financial year 1920. Also, a point to note over here is that in case if option has been exercised once by the company, the same cannot be withdrawn in subsequent years. So while opting the option, future tax planning of the company has to be taken into consideration. So once the option has been exercised for particular year, the same will be automatically be applying for the subsequent years also. So we'll be discussing about section 115 BAA, that is tax for tax on income of certain domestic companies. So only domestic companies are eligible to claim benefit under this section. So what exactly is domestic company is defined under section 222A, which state that domestic companies are Indian companies which carries out their activity in India and earns their base income and declares dividend from the activities carried out in India. However, there are no other specific conditions for eligibility or opting under this section. That is, the company should not be engaged only in manufacturing business or all. Also, it is not necessary that company shall have any business in the year in which the company is opting to pay. Also the company can either be the new or newly formed or existing company. So there are no time limits that the company should be from or with respect to particular any dates. Also the turnover for financial year 1780, which is relevant in case of old provision, is not relevant here. Even in case if the financial year 1718 turnover is exceeding 400 crores, even in that case, company will be able to opt for the new regimes. But an important point which was being cleared by circular number 19 of 2019 states that no MAT credit will be available in case if company is opting to pay tax under 115 BAA. So we'll try to understand what exactly MAT credit is. So what used to happen, certain companies, because of specific deductions available to them, their taxable income used to be very low, or let's say zero. And in actual scenario, they used to earn huge book profits or say cash profits. So in order to take them into tax regime, income tax department introduced the concept of MAT under section 115 JB, in which tax was payable on the cash profits or tax as per income tax, whichever was higher. So in case, suppose for example, for any company, tax as per tax income tax provision is coming at 10 rupees, and in case if their taxable profit as per book profits is 100 rupees. So in that case, the company will be liable to pay tax under MAT, and MAT at the rate of 100 rupees, and the same amount paid as MAT will be available to the company to claim as a credit in the coming prospective years for the maximum up to 15 years. So so in short, if you want to understand what exactly matched is, so it's just like the provisions of advance tax where individual pays the tax in four of the quarters, and the same is available for claiming as a credit of tax paid when the assessee is filing for return of income. However, the utilization of MAT credit is subject to the provisions as specified in section 115 JB. So suppose in subsequent years, if the MAT liability is lower than the income tax liability, then in that case the difference between the two, subject to the maximum availability of MAT credit, will be available to be set off. So for example, suppose the company has 100 rupees at MAT credit, and in coming years tax payable under income tax provision is 200 rupees, and tax as per book profits is 150 rupees. So in this case, the company will be able to take benefit of MAT credit up to rupees difference of 200 and 150, that is 50, which will be subject to the maximum of availability of MAT credits, that is 100 in the books. So in this case, the company will be able to utilize the MAT credit up to 50 rupees. However, in case if the company is opting to pay under 115 BAA, the company won't be able to take credit of the MAT, which was which would have been credited to the company in because of any taxes paid under MAT provision with respect to previous years. So a point has to be note has to be taken of this. In case of section 15 BAB, this section was particularly introduced in order to encourage the manufacturing companies, and also under Make in India project. So only domestic manufacturing companies are eligible to pay tax under this regime, and also there are many other conditions which are attached particularly in this section. Also, the company who wants to take benefit of this section has to be set up on or after 1st of October, which was after the ordinance was brought into effect, and should commence the manufacturing business on or before 31st of March 23. Also, the company should engage only in the business of production or manufacturing. However, if we look at the definition under section 115 BAB, there are certain provisions which are yet confusing, though the same cannot be construed very easily. Also, a point to note over here is that the company should not have been formed by splitting up or reconstruction of existing business. So suppose if you want to take example of this, so suppose there is a company ABC which have two division, one in manufacturing and another pharma sector. So company decides that to demerge the manufacturing into a new company, and in case of demerger, it also decides that all the assets as well as employees as well as the customers of the existing company won't be benefited in the new company. So in that case, it can't be said that the new company is formed by splitting up. However, the same will be subjected to facts and circumstances of each case, and the same cannot be said very easily. So if we look at the summary of the new and the old regime, it can be clearly seen that effective tax rate under the new provisions of section 115 BAA and 115 BAB are much lower than compared to the earlier provisions. So this will be benefiting the companies who are opting to pay tax under this regime.
Wait 1 minute. An important distinction amongst the three sections, the alternative regimes, 115 BA, BAA, and BAB. An important point for 115 BAB, which applies to newly manufactured companies. Now, this option, if it's availed by the company in the first year of its incorporation, only then the company is eligible to claim the benefit. If they do not claim in the year one, they are not eligible to claim it in year two. However, in 115 BAA, the case they could, it's an option. They could go for the option either in year one or year two, or maybe in the subsequent years. Yes, right.
Okay. Then we move on to tax rate for the foreign companies. So the basic tax rate for foreign companies is 40%, and the applicability of surcharge in case if taxable income is between 1 crore to 10 crore, then surcharge will be applicable at the rate of 2%. And in case if the taxable income is more than 10 crores, then in that case, surcharge at the rate of 5% will be applicable. However, cess at the rate of 4% will be applicable in all of the cases. For partnership firms and LLPs, uh, in case if a basic tax rate would be applicable at 30%, and in partnership and firm, we are not supposed to look at the turnover of the firm for financial year 17-18. And in case if the taxable income is exceeding 1 crore, then in that case, surcharge will be applicable at 12% and cess at the rate of 4% respectively. So we move on to amendments for with respect to salary, house property, and other sources. For salary, the standard deduction has been increased, which increased to rupees 50,000, which was earlier 40,000. With respect to income from house property, it has been there has been a major amendment that earlier assessee was allowed to occupy only one house property, uh, allowed to declare only one house property as self-occupied. However, the limit has been increased from 1 to 2. So now an assessee can declare two house properties as self-declared as SOP. So, however, the interest deduction, which is available under Section 24B, is limited to 2 lakh for both of the houses. Also, under income from other sources, the concept of deem accrual under section 9 has widened. And in case, suppose if individual is gifting to an NR, so in that case, the same gift will be taxable in the hands of NR, and that NR will be liable to pay tax under India. uh, Amendments for PGBP under section 43, that is deduction on payment basis for interest. The scope of 43B has extended to include interest paid for any loan taken from NBFCs which accepts deposits, or NBFCs which do not accept deposit but which are systematically important. Systematically important NBFCs are usually those NBFCs which have corpus of more than 100 crores. Also, in case if there is a conversion of loan due to any debt restructuring or anything, then in that case, the conversion of interest portion on the loan shall not be considered as a payment under section 43B, and hence the allowance of same will not be available. Also, in
Yes, the amend 1 minute. Right? So the actual amendment in section 43B, it states that if a taxpayer is paying interest on a loan taken from the specified NBFCs, then earlier what used to happen is people could claim the interest expense on accrual basis on their mercantile system of accounting. Now the section 43B has been amended to provide that this interest deduction would be allowed only on payment basis and not on accrual basis. Yes, Zaria.
Okay. Also, the scope of deduction under Section 54 for capital gains on sale of residential house property has increased. This amendment has been brought in order to benefit the middle class peoples, specifically joint families. So, in case if there is a sale of residential house property and the capital gain is not exceeding 2 crore rupees, so in that case, deduction under Section 54B can be extended for two house property. However, in case if capital gains is exceeding 2 crore, then in that case, deduction under Section 54 will be restricted to purchase of only one house property. Also, for short, also under Section 111A, short-term transfer of units of funds will be included and will be eligible for concessional rate of 15%. So what exactly funds are? So funds of funds are those mutual fund schemes in which the fund manager or the fund house invests the corpus in the mutual funds of the other companies. So amendment for tax audit. So this is an interesting amendment which has been brought by Finance Act 2020. However, the same is effective for financial year 1920 also. So in this case, if the tax audit limit has been increased to 5 crore, which was earlier 1 crore, but the same is subject to fulfillment of certain conditions, which states that in case if the cash receipts and the cash payments of the business are not exceeding 5% of total cash receipts or total receipts and payments, so the company in that case the higher turnover, that is 5 crore criteria, would be applicable. Also, to a point to note is that the receipts and payments will be including both capital and revenue. uh, the due date for tax audit for the financial year 1920 as on date is 31st of October. All the other section which give reference to section 44 AB are being amended accordingly. However, certain TDS provisions which are applicable to individual and HUF in case if their turnover exceeds 1 crore are not yet amended, and also the provisions of section 44 AD, that is presumptive taxation, which is available for benefit of individuals, HUFs and firms, are not yet amended. So an individual HUF or firm can declare their turnover between 2 crore to 5 crore and show their net profit even at lower percentage of 1 to between 1 to 6%, and they will be benefited under this. However, an amendment or clarification is awaited with respect to 44 AD.
Yes,
Uh,
Zaria. One minute. Can you just go on to the previous slide? Yes. The threshold of 5% regarding the tax audit. Now, the two conditions which provide for a higher threshold of the tax audit limit, they provide that 5%, sorry, the total cash receipts cannot exceed 5% of the total receipts. Now, how does one determine or compute the total receipts? Would it be restricted only to, receipts pertaining to your turnover or sales, or would it also include the other receipts? For example, if person has received certain kind of loans, or person has received some sort of gifts, as per the provisions, all those kind of receipts would also be required to be factored in to compute the total receipts. And if person has received probably receipt pertaining to turnover which is maybe only 2 crores, and the other receipts would be approximately 10 crores including loan transactions and all. So here the total receipts would be amounted to 12 crores and not only 2 crores which pertains to turnover. Similarly, as far as the limit for payments, even if any payment is made for acquisition of an asset, or probably a loan is given to some other party, all those payments would also be required to be factored in to compute the total payments. And if the cash payment exceeds 5% of those total payments, then tax audit would be applicable. Yes, Zaria, over to you.
okay. We'll now look on chapter 6A deductions, which are brought into which are new deduction available for financial year 1920. So new section 80 double EA has been introduced, which provides for interest on which provides for deduction for interest on loan on purchase of affordable house. However, the same is subject to certain conditions, which says that the new house property purchased by the individual should be the only house property, and the loan should be taken from financial institution only. The deduction under this section is restricted to 1,50,000. Another section 80EEB has been introduced in order to boost the economic cars, that is electric cars. So under this section, interest on loan for purchase of electric cars is provided, and the limit of the interest amount for the financial year is 1,50,000. There is also an amendment in section 80 IBA. So to brief about 80 IBA, this deduction is available only for the real estate developers, and the same and in case if they are fulfilling certain conditions which are prescribed under section 80 IBA, then in that case the total profits from that particular project will be exempt, will be available for deduction under 80 IBA. So certain provisions or certain conditions of 80 IBA are amended, and the same are brought in alignment with the GST provisions. And these amendments are applicable for the projects which are approved on or after 1st of September 2019. So earlier only four metropolitan cities were covered, but now other cities such as Hyderabad, Kolkata, and the whole of Mumbai are also covered. Earlier, the limit for the residential unit was restricted to 30 square meters in case if the project is in metropolitan cities, and up to 60 square meter in case if the project was in non-metropolitan cities. However, in case however, now the limit has been extended to 30 square meter in case if project is in metropolitan cities, and up to 90 square meters in non-metropolitan cities. Earlier, there was no restriction on stamp duty value of residential units. However, now additional condition has been inserted in order to be aligned with the GST provision, and in that and according to that, the SGV of the affordable house should not exceed 45 lakh rupees. Will now be looking at amendments which have been brought because of the COVID-19 pandemic, which will be affecting for the financial year 1920. So certain deductions which are provided under Chapter 6 Part A now can be claimed even if investments are made after 1st of April but up to 31st of July. Uh, however, the option is given to the assessee. So in case if assessee wants to claim this option, same can be claimed. Also for capital gains deduction, which are given under section 54, the time limit to withdrawn from the funds from capital gains account scheme has been extended till 31st of July. Also, interest under section 234A for late filing of income tax return is applicable in case if return is filed after the due date, only if the tax amount is exceeding 1 lakh rupees. However, in case if the assessee pays the amount of tax before the due date, so in that case, based on the Supreme Court judgment of AC Pranay Roy, interest under section 234A won't be applicable. Also, some relaxations are given for non-residents which were stranded in India because of COVID. So, in case if non-residents are stranded because of COVID, so in that case, that period of stay won't be calculated for calculating the residential status. The due date for filing return of income for the current for FY 1920 as on date are extended to 30th of November 2020. So now we'll be looking at amendments for return filing provision. While calculation of self-assessment tax under section 140, deduction shall be available for tax relief under section 89. Also, the return filing provision, that is section 139(1) provision, seventh provision has been added, in which there are three conditions are specified for mandatory filing of return, which states that in case if individual has withdrawn for more than 1 crore rupees in the whole year, or in case of the electric consumption of that particular individual is more than 1 lakh rupees, or in case if that assessee is paying more than 2 lakh rupees for foreign tours. So in if any of the three conditions are satisfied, and then in that case the person will be compulsorily be liable to file his return of income. Also, the threshold for non for prosecution on non-filing of return under section 276 double C is now increased to 10,000, which was earlier which was earlier at 2,500.
Just one change,
Another
right? Can you go back to the earlier slide? Yes.
okay.
The three conditions which are mentioned in the seventh proviso to section 139(1), where the return filing has been made mandatory. The first condition talks about deposit of any amount exceeding 1 crore in the bank account. It does not talk about withdrawals, but it talks about deposits, and it does not talk about cash deposits. Deposits could be in any form, either in cash or maybe through any other banking channels. Probably if a taxpayer has received a loan or a gift, or you just have to aggregate the total receipts in your bank account, and if that exceeds 1 crore, then ITR filing would be mandatory. Yes, Daria.
Okay. So we look at the other amendment which were brought into by the ordinance. So MAT rate, which was earlier at 18.5%, is now reduced to 15%. Also, the applicability of buyback tax is now applicable on listed shares with effect from 5th of September. However, the same will be excluded in case if the public announcement for listed shares on buyback was made before 5th of September. Also, in order to give a boost to the automobile sector, additional depreciation on car has been provided in case if the car is purchased on or after 23rd of August 2019. So we'll now be looking at case studies. So people can answer through chat box. So suppose there is a company XYZ and the company has appointed you as a consultant for filing tax return. So you need to advise which option, that is option under new regime or as per the old provision, will be beneficial for the company. So the taxable income for the company is 200 and book profits for the company as per section 115 GB are at is rupees 100, and company has met credit available in his book at rupees 50. So you need to calculate which option would be beneficial for the assessee to as per my tax outflow, and also calculate the tax outflow, but ignore surcharge and cess for the calculation. You can send your answers via chat box.
Yes, Daria, you can do the solution.
Okay. So under the normal provision, my taxable income is 200 rupees. Income tax expense will be at 25%, will come at 50. Since under normal provision, MAT is applicable. So in that case, MAT will be calculated at 15% of my book profit, which will be coming at 15 rupees. And since the company has MAT credit at MAT credit of 50, so the company will be able to take benefit of that, which would be the difference between the two and subject to maximum of 50 rupees. So in the given case, the difference between tax as per income tax provision and tax under MAT is 35, and the company has credit of 50 rupees. So the company would able to utilize MAT credit up to extent of 35 rupees, and the final outflow for tax will be 15 rupees. However, in case if the company is opting under section 115 BAA, then tax will be calculated at 22%, which will come out, which will be coming at 44, and no MAT provisions will be applicable, and my total tax outflow will be 44 rupees. So in this case, it will be beneficial for the company to opt under the normal provision, though my tax rate is higher, but the company can opt to pay tax under the lower regime in the coming years. However, in case if the company did not have MAT credit, so in that case, section 115 BAA will be beneficial. So while calculating while calculating the tax outflow, comparison should be made between both of the regimes, and the beneficial has to be taken. So in this case study, you need to determine whether tax audit is applicable. Over here, conditions satisfied state that cash payment and receipts are not exceeding 5% of their total receipts and payment. So there are five total categories.
Yes, sir, you can discuss them individually.
So in case of individual who is in the business of retail and his turnover is exceeding 1 crore, however, he is satisfying the conditions of 5%. So in that case, the higher turnover criteria of 5 crore will be applicable, and hence the individual won't be subject to tax audit. In case of brokerage, his turnover is at 1.5 cr and his profits at 8%. Brokerage, the individual whose income is who's earning his business, who's earning his income through brokerage, won't be applicable to claim 4480 deduction. However, since he's satisfying the condition of 5%, no tax audit will be applicable. In case if not satisfying the condition, then in that case tax audit will be applicable. In case of an individual, third scenario, in retail business, his income is 2.5 crore, and since he's satisfying the condition of 5%, so no tax audit will be applicable. In case of in fourth scenario, in case of company into manufacturing business, since the company is satisfying the condition, so no tax audit will be applicable. But in the fifth scenario, since the company's turnover is greater than 1 crore, and also the company is not satisfying the conditions of 5%, so in that case the company will be subjected to tax audit. So that's it from my part, and any questions, if any, can be addressed to the chat box.
Yeah. Vishesh, you would like to add something for the benefit of
Surely,
participants?
surely. So we'll just take a couple of other changes which are applicable for assessment year 2021. Now, if we have seen in the last couple of days, if we download the Form 26AS, the scenario or the format of Form 26AS has changed tremendously. I think up to assessment year, up to the date of 5th of August, whenever you used to download Form 26AS from the income tax portal, it was in the old format. And thereafter, if you download the new one, additional columns have been inserted in Form 26AS now, wherein additional details as far as loan deposits above a certain limit, or any sort of uh, property related transactions or any other asset related transactions are also being reported in your 26AS itself. For example, if a company has deposited cash above above a limit, it's now being reported in the 26AS itself. It's because of the SFT filing, which is being made mandatory in the case of the companies and the other taxpayers in the hands of the banking companies. Similarly, if a taxpayer has invested in a mutual fund above, a limit of 1 lakh or 2 lakhs, even those transactions are now being captured and now they are being reported in Form 26AS. So in a way, what's happening is there is a lot of information coming on from all other different sources, and now the IT department is trying to report all those transactions in Form 26AS itself, which would help the taxpayers, in terms of reporting while you're filing your ITR. So this is a major change as far as Form 26AS is concerned. And some other changes would be, 1 minute. Another important change as far as assessment year 2021 is concerned is as far as charitable trust is concerned. Now, Finance Act 2020 has brought about an important change wherein they have, completely revamped the taxation provisions of charitable trust. They have inserted a new section called 12AB. And what this section provides is all the existing charitable trusts are required to re-register themselves under the new provisions. And this whole registration process would now be carried out electronically. The original effective date was 1st of June. Now, owing to the pandemic, all the due dates have been, delayed, and now from 1st of October, all the trusts are required to re-register themselves under the new provisions. These re-registrations are also required for, claiming deductions under Section 80G as well as Section 1023C. And yeah, that's it about, for assessment year 2021. These are the major amendments. I think the area has covered all of them. And if we have any more questions, we would definitely, be happy to answer them.
Any questions? I would request participants to please post on the chat box. I think there are no questions. So just a few announcements which I would like to make. We will be coming up with the changes in income tax returns, a benefit of lecture for students, maybe in the next week itself. And then way forward, we will be coming with the lecture for in respect to audit, how to audit with having respect to work from home with reference to standards on auditing. That will be also be there in the start of the September month, so as to facilitate and uh, having a giving a imparting knowledge to CVOCA students and other students for the smooth work and audit season. Coming to the pleasant vote of thanks on behalf of CVO Chartered and Cost Accountants Association, I would like to thank Chairman CA Vishesh Sangoi and Dhairya Dedia. He has taken a great initiative to present the changes in the Income Tax Act. Secondly, Vishesh is having a great and enlightening knowledge. He has shared with us. Dhairya is having being associated and has given, I think, second lecture at our association. Last year it was a live lecture at in a conference room. So thank you, Dhairya, for being with us and imparting the knowledge to the students. Thank you, Vishesh, once again for chairing the session. Thank you, everyone, and hope to see you again in the coming lectures. Thank you.
Thank you, Farin.